Hey everybody, welcome to our YouTube channel, and I think that this video is going to be a bit controversial because this is all about preparing for the worst. What do you mean about preparing for the worst? The market is still rocking and rolling, and it is. But I want everybody out there to ask themselves this question. Does the market feel right? And if it doesn't, I'm going to let you know why it shouldn't feel right to you right now, because there's a lot of things in the background that you need to be aware of that you do need to prepare for. So if you want to know what those things are, you sit right there. Let's talk about why I say being prepared for the worst. You ever heard the statement, it's going to get worse before it gets better? Well, right now, the market was looking bad. We are in a recession. GDP has been down for 2 quarters in a row. But still, with that, couple of things that strike my attention. One, unemployment is still low. And with today's data, we added another 528,000 new jobs. That doesn't feel like a recession. Normally in a recession, people are having a hard time finding jobs and people are cutting or laying off people. Now, if you follow me on Twitter, I've been tweeting out all of the companies that have been getting into the idea of laying off people. That's not good news. So that's what's big. Where's the news headlines that say that the market should be doing what it's doing right now? There's a few things going on. We still have a war with Russia and Ukraine. Tensions are building in China over Taiwan. Oil has come down in price, but gas prices are still high. And the reason why oil is coming down in price is because the demand of people driving has dropped off. But the story is still the same. Low supply, high demand, not as high as it has been, but the demand is still high. Where are we going to get the oil to supply the high demand, especially when we start to get into the colder seasons? All right, so my big first thing is that where is the news that's driving this market higher? Now, don't get me wrong. I'm not trying to be a Debbie Downer about the market. If the market is giving you an opportunity to make money, by all means, grab the bull by the horns and go make that money. But I need you to be cognizant about things that are going on in the background that you need to be aware of. And my first thing is the news. There's nothing that's driving the market higher right now. So the next thing I want to talk about is inflation. Inflation is still at 40-year highs. Again, is it getting better? Not quite. Is it going to start to look like it's getting better with the raising of the interest rates? I think that the next inflation number may not be as bad as the previous ones, but inflation is still high, driving prices higher, hurting people in the pocket when they go to put gas in their car, when they go to buy food, and all of those things. The people are still hurting, but the market's still moving higher? That's something to keep in mind. So now in VectorVest, we do have a way of tracking inflation. We have the CPI VV, which takes the inflation number and puts it on a VectorVest scaling between 0 and 2, where above 1 is favorable, below 1 is unfavorable. Notice that our CPI inflation is at 0.88, unfavorable. So we already know that the inflation number is unfavorable right now. But you can see it on a VectorVest scaling between 0 and 2 to help solidify that. Now, with inflation still looking bad, the Fed's got the wherewithal to continue to raise interest rates and become what? More hawkish. That's still not good for the economy, and that's not good for us. Why? Because with the raising of the interest rates, he's taking money out of the economy. He's making it harder for companies that employ people to borrow money to grow their businesses. Because now if they borrow it, they're going to have to pay it back at a higher rate. They may think twice about pulling the trigger on pulling off a new loan at this time. But that's what raising interest rates are all about, is to slow the people's ability to get and hold on to money. So when we look at the inflation number, we've done the same thing, looking at T-notes and putting it on the VectorVest scaling between 0 and 2. That's going to pop up, and there it is at 0.52. So inflation, actually the interest rates are even worse than looking at inflation. Why? Because nobody wants the Fed to raise the interest rates, but they're still at historical lows nonetheless. And I'm thinking that in order to get a stranglehold on what's going on, interest rates need to be at somewhere between 4 and 6%. Right now, we're at about 2.25 to 2.75. And as he continues to raise the interest rates, he'll get higher, closer to that number of about 4 to 6. Now, why is that important? Because when it comes time to stimulate the economy, what does he do? He drops interest rates. If he tries to drop interest rates now, he's got no wiggle room to the downside. But there's no need for him to try to release or bring interest rates down. He's not trying to stir up the economy. He's trying to slow it down. Now, the next thing that comes to my mind, more stimulus is coming out. That's the third thing. Even in a recession, is it the right time to still spend money? Well, we got the CHIPS bill out there. We've got the inflation reduction bill out there, and I'm sure there's a couple other bills that are out there, and we're still sending money to Ukraine. I'm not saying that any of these things are bad or good. All I'm saying is that we're spending money. As we continue to spend money, we're going to put more pressure on rising inflation. And then what that does for the Fed is they got to get even more hawkish on trying to go after inflation if it's not going down. All right? Next thing. Let's look at a fourth thing. How are industries moving in this particular environment? So in the VectorVest tool, in the Unisearch, we've got a search called 10-day price delta, where I can see a change in price on industries over the last 10 days. All right, so if I run that right now, I can see what industries have gone up the most over the last 2 trading weeks. Mining uranium up 24%, almost 25% over the last 10 days. This is a good way, as the market is rising right now, to find what industries are on the rise. Now, we track over 200 industries. Mining uranium is up almost 25%, and it's number 81 as far as industries rank. Software business up over 20%, telecom up over 20%. This is a good way to try to find where to start to put some investments. We make it real easier for you to do. Now, I'm going to take this a step further. How about not only finding the industries that have gone up over the last 10 days, but let's see how they compare to over the last 20 days. So if you're a VectorVest subscriber, I took that search and added one other line, that the industry price split adjusted, a delta, but over the last 20 days, these companies had to have been making money. All right? Had to be over zero. So they've made money. But I also want to use this list to see what companies have made money over the last 20 days and are increasing in price over the last 10 days. Let's go run the search. And we see mining uranium over the last 20 days is up 23.5%. Over the last 10 days, up just a little bit more. Okay, I'll look at that. Software business up 18%, up just a tad bit more over the last 10 days. Okay, I'll take that. Notice that there's not a big jump from the 20-day to the 10-day looking at now. This is helping me to find momentum in industries. Telecom up 27% over the last 20 days, but only up 20% over the last 10 days. That shows me that the industry is losing momentum. Looking at retail mail order, up slightly. Looking at steel alloy, dropping over the last 10 days. Looking at energy clean, a little bit of a rise. Looking at petroleum. Now, we know that petroleum is on the rise again. That's one staple that is moving over the last 20 days compared to 10 days. You want to find out where to put your money? I still think that petroleum is a good place to be because supply is still small and demand is still high. Let's go look at computer networks, 15% compared to 11% over the last 10 days. Look at this. Crypto stocks, big move on coin because of BlackRock, but look, over 33% up on the last 20 days, only up like 11.5% over the last 10 days. This is a good signal to tell you to be very careful in those crypto plays right now. And as I go down the list, I can see the companies that are up over the last 20 days, but not nearly as much over the last 10 days. this is another sign that many or most of the industries are not continuing momentum from 20 days to 10 days. That's another sign to say, something just ain't right. Now, I've got one more thing. Let's go back to the graphs and let's go put this on how we use it. All right, remember, this is a 30,000-foot view of the market. Here's our earnings trend indicator, looking at the S&P 500, our earnings, and putting that same on the scale between 0 and 2. This is why we still say that we're in a bull market right now. Until this number comes below the value of 1 on that VectorVest scaling, we're in a bull market. Notice that we're pulling back. Now, the earnings trend indicator is still above the value of 1, but pulling back. That's another sign. When was the last time we were in a bona fide bear market? Back during COVID times, where we did fall below that value of 1, that was a bear market. Since then, getting into 2021 until right now, we're still in a bull market, but this is the first time since January of 2021, over a year, the first time where the earnings trend indicator is starting to fall. That's another sign, all right? And then let's go look at the S&P 500 earnings, still on overall. We still have them at 9.23% overall on our forecasted earnings for the S&P 500. I want you to start to look and pay attention to this. As earnings are coming out for this quarter, which is quarter 3 and quarter 4, I need you to watch how many companies miss earnings. That's going to be another sign to get prepared for the worst as well, because earnings is the engine that drives a market higher. And once the S&P earnings starts to fall, all right, and get lower, you'll also know that that is a sign to start to get prepared for the worst. I still think that we've got a great time to make money right now. Don't get me wrong. With that being said, take what the market has to give you. But look at the signs behind the scenes that let you know, don't get complacent in what you're doing. Let the market come to you, but don't be like a lot of people get caught blindsided and go, holy smokes, the market went down. What happened? I'm letting you know to just look at the signs. Take the money as you can make it, but don't get complacent in what you're doing. If you like the content, don't forget to hit the like button, especially if you found it insightful. This is not fear-mongering. This is not anything. I need VV Nation and all of you who are not part of VV Nation to be well informed. You remember the call, football commercial used to come on where they showed you a play, and then when they went to the next commercial, it says, you make the call. That's what I need you to do right now. You make your own decisions. I'm bringing things that nobody is talking about, and I don't want you to be blindsided. So with that, again, this video is over, and until the next time, see ya.